Welcome to our 2020 Investor Update. Today's agenda is straightforward. First, I will share a brief investor update. Then I will discuss some planning ideas and strategies you can consider. Before I get to the presentation, I would like to take a minute to remind you to stay safe and please try to also stay positive. We're all experiencing challenging and unprecedented times, but as Ralph Waldo Emerson said many years ago, the first wealth is health. Before I begin, I find it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is about the equity markets, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. What if I told you a global recession was coming, the U.S. might start a recession, there was going to be a trade war in China, the president would get impeached, and the Middle East would fire rockets at U.S. military bases? Would you have expected the stock market to go up? Well, that happened, and despite all those concerns, 2019 was a healthy year for investors, and 2020 started on a very strong note. Then in mid-February, after making a new all-time high, things changed quickly. A silent but deadly virus quickly decimated an 11-year bull market. After the strong year that was not foreseen in 2019, in less than 3 weeks, the S&P 500 fell from a 52-week high to a 52-week low. This quick waterfall of the equity markets has set many records. Although most experts predicted a reasonable year for 2020, we are now in an unexpected period where it seems as if the economy outlook is evolving daily. Knowledge is power. I believe an educated client is our best client. So let's examine some data. After an 11-year bull market, we quickly entered a bear market. A bear market is defined as when the market falls at least 20% or more from its 52-week high. A bear market's most basic principle is that bear markets are part of the investing experience. Since entering the bear market as of early April, a bounce back of equity markets may have ended this bear market, but we are still in very volatile times and are down from all-time highs. Since we are discussing bear markets, a close of 20% down, it might be helpful to review some information about bear markets. Bear markets can be classified into one of 3 categories: structural, cyclical, and event-driven. Structural bear markets are those created by imbalances in financial bubbles, very often followed by a price shock such as deflation. This happened in 1929 and again in 2008 when the financial system was in trouble. Cyclical bear markets are ones that are typically a function of the economic cycle, marked by rising interest rates, impending recessions, and falls in profits. Event-driven bear markets are created by events such as war, an oil price shock, an emerging market crisis, or like most recently, a sudden viral pandemic, COVID-19. We're currently in an event-driven bear market. These are the bear markets that are hardest, if not impossible, to forecast or navigate. COVID-19 created a first of its kind bear market, one that was caused by a virus. We've had event-driven bear markets, but none were created by a viral pandemic. After lowering the Fed funds rate by a half point or 50 basis points to a range of 1% to 1.25% in between its regularly scheduled meetings, as a response to the risk the COVID-19 coronavirus outbreak was creating, the Federal Reserve cut its benchmark interest rate in mid-March by a full 1% to 0 to 0.25%. When the Fed first started reducing interest rates, many experts noted that the central bank was catching up to where markets had headed. Now it seems as if they are responding to both the economy and the fact that the 10-year Treasury had fallen to all-time lows. The all-time low for the Fed funds rate is effectively 0. The Fed has only lowered their rate to a range of 0 to 0.25% twice, once during the financial crisis of 2008 and now again in March of 2020. The U.S. government is responding by trying to prevent the threat of a recession and help businesses. They have passed several bills, including the $2.2 trillion Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act. This emergency relief package is the largest economic relief package in U.S. history. As if things weren't bad enough, the oil price war between Saudi Arabia and Russia, which emerged suddenly and dramatically on March 7th, decimated the energy industry. Oil prices saw the worst month and quarter in oil price history, down over 50%. With energy companies and oil still being a contributing factor to the overall economy, oil prices added to the equity market's problems. A bad decision could be harmful. As this chart shares, the 6 biggest point declines and the 6 biggest point increases in the Dow Jones Industrial Average all came in the last 5 weeks of this quarter. On March 12th, the Dow Jones fell 2,352 points, which was over 9%. Had you sold that day, you missed the next day's March 13th rise of 1,985, also a move of over 9%. This level of volatility is unprecedented, and therefore even the savviest of investors needs to proceed with caution. The volatility and turbulence of this current economic and political environment has caused even some of the most seasoned investors to become skittish. In March, legendary investor Warren Buffett said that he hadn't seen anything like the coronavirus pandemic. Bespoke explained in a post noting that the average stocks in his top holdings on March 24th were down 37% from their February highs. Perhaps the most important thing to think about is that, like everybody else, his portfolio obviously hasn't been immune to all this volatility. This is a good time to recall one of his most famous quotes. The stock market is a device for transferring money from the impatient to the patient. How should an investor approach the rest of 2020? We advocate being prepared and not scared. How should an investor move forward? One of our responsibilities is to look at all situations and guide our clients with ideas. Even a treacherous downfall has opportunities. Let's quickly review some of them. Thinking long-term is still the way to look at equity investments. Typically, the most successful investors think and act for the long term. It's near impossible to predict exact market movements. However, you can prepare. While no one likes losses, from a tax standpoint, they can be helpful. A tax swap is a strategy that involves selling an investment that has losses and replacing it with a similar but not identical investment. This tax loss can then be used to offset gains, or it could be banked to offset future gains. There are some rules to understand, like the wash sale rule, so if this is a strategy you want to discuss, then please call my office. Maintaining a properly designed and well-diversified portfolio is important. Now is a good time to look at your portfolio and consider any rebalancing that may need to be performed. For many investors who had a 60-40 stock to bond portfolio a few months ago, this percentage may have changed in the past few weeks. For some investors, this could include selling things that have risen and buying things that have fallen. This can sometimes be a good opportunity to invest at lower prices. The required minimum distributions, or RMDs, for 2020 on some retirement accounts have been waived. Some investors may not need to take distributions from their retirement accounts at this time. If you're comfortable with suspending distributions and looking for a potentially better time to take them, please call my office and we can see if this strategy works for your personal situation. Though they can be complicated, there are many reasons to consider Roth IRA conversions. These include Depending on who wins the presidential election this year or how much the government injects into their stimulus, there is a chance that for some investors, tax brackets may rise. Also, for many retirement accounts with equities, account values are down. This can create opportunities, especially for those investors currently in the 12, 22, and 24% tax brackets. Another reason to think about the pros and cons of Roth conversions is the new Secure Act's change to inherited IRAs. As a reminder, on December 20th, 2019, a major piece of legislation known as the Secure Act was signed into law. This new act brings massive changes for those of us with retirement savings. The deadline for filing 2019 income tax returns has been officially changed to July 15, 2020. The deadline for making 2019 IRA and HSA contributions has thus also moved to July 15, 2020. Deadlines for contributions to workplace savings plans have not changed. Please check with your state for any changes to state filing deadlines. Most states have followed the federal government's lead, 40 states, and have moved to July 15th, but not Mississippi. It is currently May 15th. Check with your tax professional for your specific state's tax filing deadline. Equity market volatility is back and it can be scary. That's why we always say, proceed with caution. Fear sells, and everywhere you look, the media magnification of the current financial crisis is putting a major emotional strain on most viewers. During these times, it is prudent to resist the temptation to watch news reports and obsessively watch your portfolio performance. Sometimes, the more information you have, the more likely you could make a decision that deviates from your long-term strategy. Adhering to a long-term investment plan often requires taking the news with a grain of salt and putting the impromptu advice of others on the back burner. Remember, panic and bad decisions can cause more harm for investors than a virus or a downturn. As a recap, what are some key takeaways for investors? 2019 produced strong returns for equity investors. Extreme volatility has reemerged. Your health is our first priority, and continue to focus on your personal goals and call us with any concerns. So, what can you expect from us? You can expect regular communications, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. Thank you for your time today. Remember, your health and well-being is our highest priority. We appreciate the opportunity to assist you with your financial needs. We would like to help others in 2020. In fact, we would be honored if you could share some names of friends to add to our mailing list so that they can benefit from our information as well.